Should you look at price charts when it comes to investing? You can see some of them, over that shoulder on Bloomberg. So let's look at how you might master investing using charts. But you never use them exclusively, and there are those who just aren't visual, and there's no point them even looking at them. But let's look at an overview, and then I'm going to give you a ton of free materials so you can take it forward if you find investing using charts useful. These are the things we're going to discuss in this video. Okay, understanding charts, technical indicators, tools, chart patterns, and developing a strategy. And I'm going to keep it short and simple so that it's an overview before you delve into it a bit more deeper. Think of me as you've just entered Oxford University and I'm lecturing to you. I used to actually do that in behavioral finance. So you're one of my students and I'm giving you a quick overview of what we're going to cover. Okay, so let's start off with the introduction. What is it? Well, it's another word for charting and looking at price patterns. And it works on the basis that whilst historic patterns are not guaranteed to repeat themselves, they increase the probability beyond mere randomness, and therefore there's profits to be made. Okay, that's the fundamental tenet of it, pattern recognition. Now, that pattern recognition might happen from just looking at the prices. It might come from looking at prices in combination with their averages historically, mathematical operations upon the prices, or volume. And it appeals to people such as me who like to look at as many pieces of information as possible and weigh them accordingly. Now, technical analysis, I think in the US really became very popular during the 60s and 70s as computerization on the trading floors increased. It gave you something of an edge. Actually started in Japan with candlesticks and rice farmers. I think in the 1600s it was. There's some very good books on candlesticks and charting back then. The modern tools are ones you'll all have heard of, and every single one of them is guaranteed not to work 100% of the time. However, Deutsche Bank, Goldman Sachs Wealth Management, UBS, all the banks will have teams of charting analysts, because just like looking at bank accounts, the accounts of companies isn't guaranteed to tell you what's going to happen in the future with those stocks and stock prices, neither is looking at the charts, but they're both incredibly valuable pieces of information, whether it's self-fulfilling or otherwise, does tend to give an edge to those who continue to use it. Now, the benefits are it's visual. You're looking at a lot of market data which others might not be looking at. Okay, and it can be time efficient for you as well. The limitations are there is no guarantee it will work in the future. And of course, if there's a massive news event, then you're looking at the chart, you forget that interest rates are about to be announced, and you think, how come that doesn't show up? Okay, so you've got to be aware that news and fundamentals also operate. It's often said that chart prices operate in the short term, and longer term fundamentals operate as well, and you shouldn't use charts to gamble around news events. So what are the chart types we might look at? Of course, line charts, easily and simple. There's bar charts you might have come across. These will tell you the highs and the lows. That's the wick. And then the body is the open and the close. They're the ones I tend to use. And there's candlesticks, Japanese candlesticks, where the color of the bar, you can see them on screen there, is based on whether the price closed lower. In other words, it opened high and then closed lower. It went down, or the other way round. And red and blue are common colors. And again, patterns can be determined based upon them. Okay, this is just an overview, of course. What are the key technical indicators and tools? Well, people have their favorites. Probably the most basic is moving averages. It's a bit of a lagging indicator. In other words, people's main complaint about this is, well, wait a minute, that's the average price historically. That's lagging and it doesn't work. You're looking in a rear view mirror to look at something going forward. Absolutely correct. If you can look at patterns and make it work for you, good luck to you. I tend not to use moving averages for all the obvious reasons and complaints that people have of them. Relative strength index is a popular one. They mention it on TV. Fund managers often mention it. I think it's too volatile. I can't see it. And I think that's a general rule for me in charting, is if I can't see it and the pattern, then I don't want to be using it. Okay. And I've covered this in many of my books, including Investing Unplugged, and you can download a free copy from the link which is down there. Okay, my more favorite is the moving average convergence divergence. I also like Ballinger bands. they measure volatility of price moves. The idea is if the price it reverts to its mean volatility. In other words, if it's going through a period where there isn't much volatility, i.e. the bands tighten because there isn't much volatility, then it'll probably revert to mean and explode. Equally, the theory is, and each one of these indicators has their own theories, if it's going to one extreme of the Ballinger or the other, it may well revert to mean and go back in. But there are exceptions to all these rules, which is why, again, people say, that one's rubbish. But it's important to have an understanding of statistics, and you're looking for a slight edge, not a guarantee. Okay, so Bollingers I've used in the past. I quite like them. I think they're worth examining. Then there's patterns, and this is where we come to pattern recognition. You look at the charts. There's simple patterns like head and shoulders. Some people say these have now broken down in the age of computing. Others say, nope, self-fulfilling. They still work, double tops, double bottoms, and so on. There's hundreds of different patterns. And the idea is, if it's happened before, it may well happen again. And some say the prices reflect psychology of the markets. Others say it is just self-fulfilling. Others say it's absolute nonsense. You decide to see what you like. And then there's these patterns. And actually, you can get computer programs which will draw these patterns onto charts and then will tell you the probability of it working out or not. Stockbrokers love this because what it does is it generates more turnover and churn amongst clients for them because the clients keep betting upon these and say, oh, that's really clever, I'll go for that pattern, I'll go for this. And of course the clients over leverage, get overconfident. Remember, all the tools a stockbroker will ever give you are there to make you trade more, and the way they make you trade more is by making you more confident. So the job of those tools is marketing. It is to make you more confident, overconfident. You bet too large a size. A small move when it doesn't work wipes you out. They don't mind if you make £1 9 times in a row, as long as you lose £10 on the 10th go. Okay? And that they know will happen. Okay? Because people tend to cut their profit short and let their losers run, because that's human psychology, and they're betting on that human psychology aspect. So be careful. This is not your be all and end all. There's other things like reversal patterns. So there's patterns which confirm trends. There are those which suggest reversions and reversals as well. And I'll give you the free tools to learn more about this in a second, where you can. Okay, if you want to develop a trading strategy, what you would tend to do is look at the ones which resonate with you the most. You'd look at historically a lot of data across securities and then work out some rules, test those rules and see, does that work? Now, you don't have to test that, I don't think, in a sort of mathematical black box, let's get a quant kind of way, unless you're planning a quantitative hedge fund with a black box. What you can do is test it by eye. It's a lot quicker and cheaper, and say, well, actually, if I have a rule that should the moving average do this and the price do this, and I buy and I sell at this point, does that work? Worked here, worked here, worked here. Oh, it didn't work here. Look at the bits where it doesn't work and then work out whether it works enough. You're not trying to find something which is the holy grail and be right 100% of the time. What you're trying to do is make sure you make money even if you're right 4 times out of 10. Well, how can that be so? Well, because the 4 times when you're right it makes money should make more money than the 6 times when you're wrong. In other words, you've got to have a risk management approach which takes you out of losing positions really quickly. And that's where risk management or money management comes in. How quickly will you be able to exit if you're wrong? How do you know when you are wrong? For instance, if the price goes below a recent support level. So you would test that hypothesis. And I discussed this in one of my books, Net Trading, which is over my shoulder, and worked out strategies based upon that and showed people how to develop their own strategies. You can, of course, now with software backtest and refine these strategies. The problem with that is, the fundamental problem with that is it makes the assumption that all securities and all markets are always the same, unless you're going to add another layer of complication, which is to say these rules will only apply to this security in these circumstances, in which case you've got the other statistical problem of what's called curve fitting, that you've narrowed the rules down so much that they will only work historically under those specific historic circumstances. Again, an understanding of mathematics and statistics is very helpful. And if you don't have it, you might say, well, thank you very much for this, Alpesh. I've now learned I definitely don't want to be doing this. All of this, the whole point of this is to increase your chance of being successful and making more informed decisions. There is another way of doing that. Just like, follow my various videos. So where's the tools? Well, if you go to alpeshpatel.com/links, you'll find a whole bunch of this and free materials and even books on charting free to download from there. You'd go to alpeshpatel.com/links. You'll see there's a link to a free trading course and a free investing course. If you look at both of those, you'll find lots of free books which will cover more of charting. Just look for the words charting within those. I hope you found that quick review very helpful. Do like, follow, share, comment. It helps the algorithm, helps boost my desire to do more of these. So I hope you found that useful. Thank you very much.